if you look at Washington, we've always been, given our MSA, the size, our demographics, investment here, big tech companies that are here, like you named a couple, we've always been insulated from a lot of the market trends, the swings, right? And don't get me wrong, we experience our recessions and everything else up here, but why still invest here in Washington? Why own property here? Why deal with the high transfer taxes? Assets here generally perform, however you want to measure asset performance.
Yeah, totally.
We're high on that list, right? There's certainly pros and cons.
Yeah, definitely some insulation, and I'd also say it decreases volume of transactions. Mm-hmm. Once people buy here, they end up holding here for a long time. Welcome to the Seattle Multifamily Podcast. My name is Jerrid Anderson, and on this episode, we're hosting brokers from the Pacific Northwest, commercial real estate brokers, and we'll be talking about what we've learned in 2024 and our projections for 2025. So kicking us off, I'd like to introduce everyone at the table. Everyone's a broker in commercial real estate, so I'll start off with Jake. Jake, what's your specialty, and where do you spend your day in, day out in the business?
So my specialty is commercial finance. Where do I spend the majority of my time is putting out fires. We do a lot of deals. It seems like every single day someone within the company has a fire that needs to be put out, and I'm jumping on it to make sure that the deal's closed so you guys can get paid.
Yeah. How many year-to-date closings have you guys had?
As of yesterday, we are at about 260.
Wow. That's incredible. Mm-hmm. And primarily in Washington or whereabouts?
The majority of it is in the Pacific Northwest. I'd say probably 60, 65%. And then from there, we have quite a few in Milwaukee. We're actually kind of the it brand in Milwaukee, Wisconsin.
Big in Milwaukee.
Exactly. And then besides that, it's really sporadic throughout the nation, wherever the borrowers take us and or the referral sources. Luckily, social media is a real thing and works. So we do get a lot of requests from all over the place.
What's your least type of deal to finance right now?
My least favorite type?
Yeah.
Oh, man. That's really tough. I would say that my least favorite thing to finance right this second would be probably a 10 million to 30 million multifamily rehab deal.
That's what I sell.
Yeah, exactly. Just because there's so few lenders that are non-debt funds that want those deals at a high leverage point. There's really a gap in the market today. So that's probably my least favorite request because I don't really feel like the pricing is where it should be on it.
It makes me feel a little better. Like since September, I think we've had 10 deals of that size go under contract in apartments. And I think all but one have fallen out of contract. We're stitching some back together, but it's been a brutal few months.
The pricing just isn't where it should be realistically, and there's a lack of liquidity, so they want to limit the loan dollars per deal. A lot of the normal conventional institutions will want to limit the loan dollars per deal so then they can spread it out and diversify it amongst more transactions.
Gotcha.
So that's really a hole in the market and a big opportunity. In fact, I sat down with some executives of a bank yesterday at lunch, and I told them that this is something they should be doing for this exact reason, because you can charge a little bit of extra yield on it and fill that gap, and everyone wins.
Yep. Nice. David, specialty, where you spend your day?
Retail investment sales in Washington, primarily. A little bit of Oregon, a little bit of Idaho, but primarily Washington State retail with a handful of office buildings and stuff a year as well.
Nice. And are you mostly putting out fires, or what's your average day look like?
Not too many fires these days. Yeah. No, just need more business, more listings. It's been a pretty low inventory environment for us still.
Yeah.
So
I'd say reflecting on the sales so far this year, if that continues, we're probably at, I'd say 40% of the annual average for the prior 8 or 9 years. What would you say for retail?
We're right there, 40 to 50% max. I think you guys in the apartment side are seeing a lot more inventory and velocity than retail right now, especially as the development kind of comes to a halt, which drove a lot of velocity for us in the state in past years.
Okay, nice. And Matt, specialty, where you spend your days?
I work as an industrial broker. I do leasing, sales, development, kind of everything for industrial properties, which can be distribution, manufacturing, kind of everything under that umbrella. But for me, it's mostly Western Washington, Puget Sound. I have clients that'll go out of state here and there, but the majority of my work here is pretty local, and definitely I have fires to put out like everybody else, but it's nothing really major. A lot of our time is spent stabilizing buildings, finding tenants, and then really trying to navigate the sales environment right now with cap rates and what's your debt and financing options look like. And so it's fun.
What I tell myself is if I could do it all over, I probably should have done industrial because you guys get leasing and sales.
Yeah.
So like when there's sales, multifamily's on. And when there's not, I'm not leasing apartments.
Well,
I don't want to.
In a normal market environment, you get a good balance of both.
Yeah.
If you look at it today, I'm actually doing almost exclusively sales because the leasing market is so slow right now.
Interesting. Okay, that was going to be my question. When it was like super robust, industrial brokers were top 5 at every company. Mm-hmm. I'm guessing most of it was sales. And that was like 2022.
You usually make more as a broker. You make more money on leasing, and in past years, like especially during a good market, inventory is usually low and cap rates are so low. So actually sales are harder to come by. Right now, sales are easier to come by because there's a couple more willing sellers. Pricing is better, so buyers are more active and interested in buying right now.
So how would you say, if you broke into a bucket of 100%, what percent leasing this year, what percent sales?
I'm probably 70-30 sales to leasing this year.
Interesting.
Versus a typical year being much more like 50-50.
Okay, cool.
Are the listings you do have, are they vacant?
Yes.
Or are they occupied?
For the most part, vacant.
Interesting.
Because we're seeing a lot of tenants either downsize, leave the market, just restructure. We had a lot of groups through COVID that, because the demand for e-commerce and everything blew up during COVID, they kind of borrowed tomorrow's space back in 2021, even 22. And then fast forward to today, they're either giving that space back or just resizing, getting more efficient. So we're seeing a lot of buildings.
And is it primarily owner-user acquisitions?
Yes.
Or,
yeah, I mean, you've seen it in your world. Those are arguably the easiest deals to finance right now. That's what the banks feel the most comfortable with. So, I mean, always have, right? But generally speaking, and those owner users have always competed with the institutions generally, which they can't, usually compete with. Right now, the institutions are very sensitive to cap rates and again, debt and everything. So the owner users are kind of taking the chance to come out and grab some things that previously they wouldn't have been able to. Just
personal curiosity, e-commerce drives cap rates on industrial properties extremely low. Now you said people are giving them back or resizing. Has there been a change in demand, or did demand for distribution not go where it was supposed to, or what happened? It's a good question. We borrowed forward. I think that's the simplest way to put it. Is you look at COVID and everyone started ordering everything online, whether you liked it or not. People were already doing it, right? And if you actually look at e-commerce trends, it's still growing, right? People are still ordering online. I think the biggest thing that we've been seeing right now, after living in the inflationary environment now for the past couple of years, is a little bit of the devaluing of the dollar and people's purchasing power. If you were ordering 5 things from Amazon every day, maybe you're ordering 1 now, right? So you're ordering less. There's less turn coming out of the warehouse. That inventory is sitting, and these operators are seeing that, and they're realizing, gosh, I don't need 200,000 feet anymore. I need 100,000, right? Because there just isn't the turn and the requirement to have that much inventory on hand. So it's just kind of a natural evolution of how we're spending money and really consumer trends. That's interesting.
Same thing as Office almost.
Yeah.
Really, yeah. That's how you're using it, right?
Speaking of Office, Will, you're in Office. What's your specialty? What are you guys doing?
Yeah, so my brother and I have been working together for 10 years now. We do office product outside of downtown Seattle and Bellevue. So let's call it suburban office in the Puget Sound. And then the other half of our business is healthcare product across the state of Washington.
What does that mean?
So so like the doctor's office, medical office buildings, hospitals on campus and off campus medical office buildings. In its simplest form, it's clinic space and operating rooms in hospitals.
Interesting. And why did you pick suburban office over urban? Because 10 years ago, I think urban might have been the trend.
Oh, exactly. Thanks for asking that question. That's a good one. So I graduated from Wazoo in 2015, and the most popular job in the world might have been downtown Seattle office leasing.
Tenant rep?
Landlord or tenant rep. It was the hottest thing in the world. Yeah. And I wanted to live in Seattle. And so I have for the last 10 years, but I wanted to find a hole or find an opportunity. We found the opportunity in the suburban office market. And then quickly thereafter, we found this opportunity in the healthcare space. There just wasn't really the broker saturation that there was in the office market.
Yeah.
So we started focusing on the healthcare market. And comparatively, the healthcare market's 15 million feet across the whole state.
Yeah.
The downtown Seattle office market's 150 million.
Oh, wow.
So it's a lot smaller.
Yeah.
But if you can grab more market share of a smaller product, we feel very comfortable and felt comfortable in doing that. And
Nice.
yeah, it's been great to work in that space because it's felt pretty recession proof over the last 5 years. And the amount of institutional money and capital being pushed into the healthcare space it's relentless. So it's a tale of two coins between the office and the healthcare space for sure.
Interesting.
Yeah.
So anyone jump in, favorite piece of advice you've heard in 2024 as we look back on the year? I'll go first because I wrote the question.
There you go.
Thanks.
You hear location, location, location. And this year I heard from one person, timing, timing, timing. And that really hit home because I've seen in the last 10 years, urban or these amazing locations do really well and really poorly due to the pandemic. And I've seen some suburban markets go just bonkers in appreciation. And now they're sliding back down and having some of their own challenges. But if you time anything right, any deal could be really good. So I thought it was interesting that timing was such an important factor.
Makes sense. I think one thing I picked up on in 24 that was kind of a piece of advice I had gotten previously, and then I really saw it come into effect in 24, because I think we'd all agree 23, 24, the past couple of years have been a very different market cycle that we've been living in. And the advice is, figure out what you're good at, figure out what you're not good at, and then surround yourself with the people that are good at the things that you're not good at. And I think when we have these deals that are more complicated than they've been from a timing standpoint, location, financing, what does the stability of the tenant and the credit look like? Because that feels a little bit more difficult than it's been in past years, where I've seen my clients and even on the broker side, these deals being more successful is when we're building really the team of all the experts, all the correct vendors, the correct financing team. I mean, I've really seen that play out this year. And
Are you quarterbacking that? You're like,
I
need
try
the right
to.
mortgage broker. I need the right, engineer, and start putting people together.
It depends on the sophistication of the client. A lot of institutional clients, for example, they already have that kind of built in, right?
Yeah.
So not necessary, but for call it the mom and pop or the local investor, that is a service I usually try to provide, is to quarterback everything, make all the introductions, the vendors, you name it, one-stop shop, right?
Yeah.
To make their job easier, make their life easier, make the investment successful, whatever it may be. So
Well, it's even a good reminder. I'm working on a deal right now. A client called yesterday, can't find insurance for this property that they want to buy. They're a great buyer for it. It's like the perfect fit. And realizing that early in my career, I was solving those things. And now I expect the people that I work with to solve them. And we need to step in and figure it out.
the value add you get out of it, even if you can't necessarily measure it, is the client you're the one-stop shop, right? You take care of everything for them. And then they're like, why would I ever work with anybody else? Matt does everything for me, right? Meanwhile, when we all work with different vendors and having that relationship, you're sending them business, right? At that point, they reciprocate, they like you, you're building a new relationship. I mean, it's just win-win-win.
Nice.
So I love it.
I think the other thing to add is kind of like timing, but from the older owners that I talk to, like 20, 30, 40 years in the business, is you just got to ride it out. I think for us, and you go from the best market in the world to not the best market, right? You think it's going to last forever, whether you're on the ownership side or the broker side. And you just got to remember it's a long-term business with long-term people. So, looking back 2 years, if we go 5 years in the future, we'll be like, what do you mean 2024 was fine, or 2023 was fine? It wasn't that bad.
Yeah.
We made some good buys those years.
Yeah, exactly. So
Wish I didn't buy everything in 2022.
I'll close it out with, I think that, I actually just hired a runner, which is...
What is a runner?
A runner is an intern. So it would be a junior broker or an associate working with Drew and I. And the runnership program, or the internship program, is a 12-month program. And I gave him 2 pieces of advice that Drew and I have followed over the last 10 years. And the first rule is an unrelenting work ethic. And the second rule is read the room. And I think the read the room's interesting because it applies to both your brokerage skills, but also like it is involved in every transaction. And these transactions that I'm working on right now are very expensive. Getting a tenant is very expensive. Selling a building is very difficult. So you need to understand and appreciate some people's maybe pain points, get more creative on deals and how to approach them and get them to the finish line. So spending more time on each transaction and having a better understanding of what everyone's goals are, especially listening to the tenant or the buyer or the seller, and then the landlord reacting to the advice that they've been given by their brokers or their team.
Any specific examples from this year where you read the room and made a difference?
I think that there's lease transactions that we've been a part of where typically a landlord has wanted to respond in a certain way, and we have advised them to not respond how they traditionally have because it's going to fall flat with the potential tenant. And so we've had to get these landlords or landlord comfortable with getting out of their comfort zone, which is like a better word for putting basically more concessions forward than they were previously used to. And by doing that, you know, you have to come with the data and the comps, and you can't just say, hey, you need to do this, you're going to lose the deal. You have to have information that backs up that claim. So getting your clients to take that extra step has been monumental for us, because it's really the difference between landing a deal and not right now, specifically in the office space with the amount of, you know, vacancy that everyone's dealing with.
And it's interesting. It's like you're doing your client, the landlord, the favor by telling them to do something that they don't want to do, and earning your fee. It's a very uncomfortable and odd position we're in right now as brokers, and I'm feeling it as well. Right? Where it's like maybe that's not what you thought this would be 7 years ago when you bought it, but it is what it is.
It is
and
what
so
it is
you
today,
can refinance and go raise more money and keep this deal, or you can sell it at this price and be done with it. Like you make the choice.
We have that conversation every week. And a lot of our sales right now are longtime owners that are exiting office buildings that they had previously had, you know, the luxury of being fully stabilized, and mainly due to COVID, they have lost their occupancy, and they're anywhere from 0 to 50% occupied, and their loan is coming due, and it puts them in a challenging spot. But they have two routes that they can take. They can double down on the office market and they can invest in their building, or they can sell at a number that is around their loan value usually, and divert that product or that cash to something else. These three things at the end of the table here.
Jake, popular belief from 2024 that you disagree with?
Look, the fact is, the best deals I'm seeing come across my desk today are office deals, actually.
What makes a best deal?
So best return out there, you know, with actually strong tenants in place.
So best return like on the books, not
from
perspective?
From a cap rate perspective, you know, or a cash on cash perspective. It's a flight to quality with office, you know, so those who have great quality are getting filled in the right locations, and you're able to buy them at such a discount that they totally make sense. So I think that you got to pick and choose correctly, and I think B and C is going to get crushed or continue to get crushed, but A quality office is here to stay, and I think that's something that in 2025, not to jump ahead, is going to be kind of a realization.
Does C, I want to shift this to you actually, David, does C ever change? And the reason, what I'm thinking of is like suburban malls, right? Or just like dead to the world. Has that been solved, or are they still just dead?
I mean, honestly, I think those are some of the, I mean, if I had a bunch of dough and was a billionaire or 100 million plus, I mean, if you could have bought some of those malls at dirt value. I mean, actually, there's one in Port Orchard where it was a mall kind of style with a bunch of interior space. They're 100% occupied.
With what?
With tenants, with mom and pop tenants.
Mom and pop retail?
Mom and pop retail tenants. So, I mean, I think, I don't know if it's a 2024 popular belief, but one of my favorite clients and best investors probably, he told me something 10 years ago that I think about all the time, which is the thing that's hot, the thing that's viewed the less risky, the least amount of risk, typically has some of the most. It's typically the polar opposite within a 1 to 2 year span. So like an example would have been, the gold standard used to be drugstores. You used to have a drugstore listing. Everyone wanted a drugstore, 20, 25 year leases, as good as a bond. Now look at the drugstore market, right? Yeah. It's probably one of the worst markets. So I like the mall space a lot. If you have a lot of money, you have to have a lot of money because you can tear it down, go vertical, put a Top Golf in. Yeah.
Interesting. Do you see B&C office a place for it in the future? Or is it just like burn it down? We'll send this to your clients.
Yeah, please do. Okay, clip this next segment. So I think like C office is really going to struggle because the floor plates and there's no efficiency with the Class C building.
Define for us laymen what a C office is.
So it'd be like 100-year-old office building, brick construction, or wood frame construction that was built in 60s, 70s. Oh. You can, there's two ways you can go about it. You can lean into the like creative brick look of the building and keep it office, like for example, Pioneer Square. Mm-hmm. Pioneer Square.
Appealing to the character of it.
Yeah, you gotta lean into the character. And obviously Seattle office market right now is struggling, but Pioneer Square at one point in time was a very popular spot for tenants because of that character. Yeah. The B office market, so buildings built 70s, 80s, 90s that at the point in time were A product and they've simply just moved to the B because of their age. Those ownership groups, to stay in the game, they need to basically fully renovate their buildings and provide all the amenities and bells and whistles that you would expect in the Class A space. Yeah. And you can still get transactions done. Like 2 Union, our Seattle building, that's not a new building. No. But it's the best building in downtown Seattle. Yeah. Because they've spent money and renovated it.
It's beautiful.
It's amazing. Yeah. So you just have to know what you're dealing with. I think something that's been talked about a ton over the last few years is this office to multifamily conversion.
It doesn't.
I don't believe it. Yeah. I mean, it's talked about a lot. It works in New York when you're like end renters, like $6 to $7 a foot. Yeah. But it doesn't really work in a majority of the country. It's just
similar
too
when the pandemic hit. Everyone's like, I had like 2 clients that actually went forward with it and didn't execute all the way, but they're like, hey, we're going to design all 1 bedroom plus dens. Like our whole building will be work from home. It's like, that's a really quick reaction to something that hasn't changed much over the last 20 years.
Right.
So you were talking about you burn it down, and you mentioned a lot of the ways that you can try to fix or improve BC office to get it to compete. But I think the problem with C, and I'm deferring to you here, but the problem with C office especially, and maybe even B office too, is that when you look at those older structures from just like a pure accessibility standpoint, ceiling height, lack of elevators, like access, like functional things that you can't fix, right? And Jake's over here, he made a great example about, the flight to quality, and like Class A office is full with good credit tenants doing really well, right? You look at C office and B office, and we can't fix some of those functional things. I mean, when you run into one of those, what do you do?
Fix them, and the cost is so high to fix them that it's hard to pencil.
No, you're seriously demolishing buildings. In a lot of markets, I think you will see demolishing buildings, and the hope is that these buildings can be traded at land value. We're looking at Class C office in some urban markets right now, and we're submitting offers at land value minus demo costs. And so specifically in downtown Tacoma, we have offers out on 2 separate sites. They're both Class C office, and both of them are on the market at owner user pricing, $200-ish a foot. We have submitted offers based on the land value minus demo. And yeah, we might not get the deal. Yeah. But
what's that delta? 200 on user to what on land value minus?
It's $200 a foot to an owner user and $50 a foot to
So that's the market speaking.
Yeah.
The market saying burn it.
And we might never see we might never see the deal, but
Yeah.
the clients that we're working with, that's how they're approaching Class C.
Yeah, you've got a legitimate buyer making an offer.
Yeah.
There's one building that I'm thinking of specifically that I know it's like about 300,000 square feet. It's like a B product, and the owner bought it at a discount because it was for the most part vacant. They're completely speccing every suite out. They're bringing in all the amenities, and it's going to be like an A++ building in an A+ location, and they're almost 100% pre-leased.
Yeah. It works.
Right. And the other thing is, if you spec it out appropriately in these days, then you don't have to do the TIs. You can actually say, hey, here's your product. It is what it is, and very minimal change from there. And then you're also getting a higher quality tenant that doesn't deteriorate the space also. So it makes it to where the TI costs on the turns, in the event a tenant does go away, isn't there either. So I think what we're seeing is a transition overall in the office market
Completely
as well.
agree. Yeah, we're working on an assignment. It's 15 floors and 200,000 square feet. We did one floor of spec suites, and the one floor of spec suites leased in 6 to 9 months, and across 6 different deals. So small deals, but built out turnkey space.
Yeah.
We're now constructing another 4 floors. So we said, okay, here's the case study. Let's see if it works. It works. Now we're doing another 4 floors of vacancy because we had our largest tenant in the building come up for renewal. Like, okay, well, we have 5 floors. We're going to keep 1.
Yeah.
We love your building. It's great. Thanks for renovating it.
Yeah.
But we are going to give back 4 floors. And that's what a lot of these ownerships are going through right now. And this ownership group decided to say, okay, I'm going to double down on office. I'm going to put more money into the building, and I'm going to renovate the project and spec out floors, and it's going to work.
Well, and I think also on top of that, that is generally what they can do is they can move into a better quality building in a better location with all the amenities, downsize their footprint a little bit, and on budgetary, they can actually be under what they were paying before. Yep. So they're hitting like every single box and still saving money. And that's what's happening in the office market.
Interesting.
Yeah.
So transitioning to our last kind of look back on 2024, what's a lesson you learned this year that you'll carry forward into your future? And I have one. Has nothing to do with brokerage, but I have applied it. It was from a book, I think it was a marriage book, but it was a chapter called Yield First. And it's like you always come into a challenge or disagreement or anything with your own opinion, and you start by trying to defend it instead of understanding where the other person's coming from. And so I've leveraged that in several different relationships, business deals, and it's been really effective. Instead of me coming in like, here's what needs to happen, it's like, what did you think should happen, right? And just start with understanding where they're coming from. So that's something I'm applying already.
What was a lesson from 2024?
Yeah, something that you learned that you're like, I'm going to apply this forever.
Jake will like this one. No one can predict interest rates ever. And
Not even Jake?
We should stop trying and just accept what is today.
Yeah.
I think my lesson from that is just for future reference, get out in front of any loan expiration date, like at least 12 plus months. I think a lot of groups we see bring it down to a couple months or 3 months and then want to try and exit because the new financing isn't super good, but just give yourself time. And like you said, timing.
Yeah.
That's my big lesson for this year.
Yeah.
I'd say it's a people business, and it was easy to forget that with the work from home trend and
That's a good one.
and Zoom,
Yeah.
And so yesterday we flew down to Vegas for a pitch and to sell an office building. And at the end of our pitch, they awarded us the listing on site, and they made it known that we were the only team that showed up in person. And this building's in Washington.
Mm-hmm.
Ownership happens to be south, and they very much appreciated that. And they said that made the difference. And it's easy to, do their Zoom and your Teams meetings when it's so accessible.
Yeah.
And I gave myself that advice. Like that meeting yesterday was a reminder for myself because it's easy to blow off an in-person meeting because it takes more time and effort. And
Yep.
So moving forward, I'm going to think about that case study daily.
Yeah.
Yeah.
Because I'm a total nerd for efficiency, how do you structure your day differently to be able to have in-person meetings, but be able to drive like phone calls forward and email and things that are necessary?
So that's the challenge. That's the challenge. I guess it's a little bit easier. We have a team of 4, and so we can divide and conquer. So yesterday I was in Vegas at the pitch, while Drew and Ryan and Katie were doing other things. So Katie was touring in Tacoma, and Drew and Ryan were in Arizona at a different meeting. So yeah, I might have some work to catch up on this weekend.
Yeah.
But dividing and conquering has been really important, but you also have to have confidence in your team that they're going to go win that business without you.
Yeah, or vice versa.
So I guess blocking out time too.
Yeah.
You know, the cold calls is the last thing I want to do every day.
Yeah.
But it's something that needs to be done every day. And I haven't done it yet today.
Feeling uncomfortable?
So we know what you're doing.
I haven't done it yet today, and I need to do it. And if I don't do it, then my cold call list for tomorrow gets longer.
Yeah.
And I struggle with that part of the business is, staying grounded instead of just running in 5 different directions.
Yeah, it's hard.
It's hard. I know David, I met with Parker, who you work with, and learned a lot from him. I think that's something I've also reminded myself of is, I mean, I'm not the young guy anymore, or a gal.
You got glasses.
Yeah, I know. I'm losing my vision. I've learned a lot from the younger people in our company.
That's great.
And it's motivating too, specifically like the technology side.
Yeah.
Those kids are a lot smarter than me.
Yeah.
Totally.
Yeah.
So elections behind us. Any bold predictions for 2025? And as a side note, any curveballs you're expecting?
Curveballs. I'll go. What's interesting is with Trump being a real estate guy, everyone thinks it's good for real estate, right? And I generally subscribe to that too, if nothing else from a perception and an optimism standpoint. I think a lot of people are seeing, but it's I don't think it matters who's getting in office. We've seen this play out in years past, right? It's just a change in administration, a change in general. People view that as an opportunity to go do something or maybe take advantage of something that they were previously sitting and waiting on, right? So I think that'll be great for the market.
Yeah, just have that behind us. Like we now know there's a change.
We know, right? There's no more excuse. There's nothing that we're kind of waiting for some shoe to drop or some expectation, right? But I think the curveball that I've been thinking a ton about lately, and this is really unique to us here just in this Puget Sound region, if you look at our local government versus kind of on the macro level, a lot of our newly elected officials, I mean, we've always had a very challenging time here in this state working through, especially like new development. You experience that probably as difficult as anyone, as much as we need new housing, how difficult they make it to build new apartments. But with development and regulation being so challenging in this state, and then you look at the new wave of government that's coming in locally, I think everyone projects it's going to just only get worse. So we see this macro potential improvement of like demand improving, maybe rates keep going down, commercial real estate's going to be great, right? But then I think about how it's going to affect me here at home. And I think we're going to be facing some serious barriers just to get things done.
When I looked at the questions before I came here, actually, I agree with you 100%. That was one of the things I had noted to myself was, if you look at Trump historically, he's pushed everything back to the states, right? There's going to be this huge push for efficiency on the federal level, and I would expect it to be more pushed to the states. So I think that each state is going to really set a different standard, significantly more than ever before, and local is going to matter. And so what happens in Idaho is going to be completely different than what happens in Washington or California or whatever. So I think to your point, you're 100% correct that local is what it's all about today.
Yeah. I'll just add, I'll drop the hammer. I have very little faith in Washington State and where things are going. So
Hey, you have clients that invest here. Be careful.
I invest here. All my stuff's here. So, I just, after, shout out to your podcast with Sean Riney, but just watching the trend of where this state's headed versus others, I mean, go to Google and type in what's the top 10 fastest growing states population-wise. There's a pretty clear metric, the states that are less regulation, business friendly, lower taxes. Those are all the top 10. And, the biggest curveball or threat I see for our state is we're becoming consistently way less business friendly. And specifically speaking, I mean, we're very lucky. Shout out to NAOP. I think it was NAOP. We don't have a capital gains tax for real estate transactions, right? They stripped that the last moment here in the state. And so now it's just for stocks and 250. Well, I was reading it this morning, prepping for this, is we have a $10 to $12 billion deficit in the state now. So how are we going to fix that? Well, we know what the formula is in Washington State. Raise the taxes. They did a hiring freeze, so I guess that's great. But raise the taxes. I can guarantee you, they're going to be, real estate's the big ticket item.
Yeah.
And then, if we just look, Washington State, I don't know if it changes so much, but we have, if not the number one, we have certainly top 3 highest transfer taxes for real estate. So I've had clients that bought a $15 million asset 3 years ago, and then they go to sell and they go, hey, what the hell is this, $500,000 excise tax fee? Like, what is this?
Yeah.
And I'm like, oh boy,
Yeah. It can crush transactions.
And so what they have said is, hey, we'll never buy a deal in this state again. Like and they keep changing it. That's the thing, is it's always going to be, once you let go, it keeps increasing. And so, my fear is thank God we have a no income tax state. Hopefully I think that's the biggest advantage we have.
On the West Coast, for sure.
On the West Coast, along with 2 of the richest people in the world happen to grow up here, Bezos and Bill Gates. Yeah. So that's super helpful. But we should be a top 5 state, hands down, for everything. And I've seen it in the business, the legacy clients who've been here generationally, not just with all these taxes, but the inheritance tax situation in Washington, they're migrating out of the state. Yeah. And so, thankfully we're in a very liquid environment still, but if we get into an environment where there's a lot less liquidity for whatever reason, we could be in some serious issues. So,
the one thing though, we were having this conversation as a group yesterday, was that if you look at Washington, we've always been, given our MSA, the size, our demographics, investment here, big tech companies that are here, like you named a couple, we've always been insulated from a lot of the market trends, the swings, right? And don't get me wrong, we experience our recessions and everything else up here. But I think about everything you said, I agree with. But why still invest here in Washington? Why own property here? Why deal with the high transfer taxes? Assets here generally perform, however you want to measure asset performance, we're high on that list, right? And so you go to like a Sunbelt state, and there's a swing in the market, and your asset might get cut in half in value overnight, right? Whereas up here, and that might happen across the country, and in here maybe it goes down 10%, right? So there's certainly pros and cons.
Yeah, definitely some insulation, and I'd also say to maybe some of our frustrations, it decreases volume of transactions. Once people buy here, they end up holding here for a long time. Right? Forever. This was years ago. I think it was like 7 years ago I read this, but I think Washington was the 3rd longest hold period state for commercial real estate. So I think it was New York being the longest, we're 3rd. So we hold things forever, which means fewer transactions, fewer fees. It's like, it's not a very broker-friendly market.
Almost all my transactions are private wealth selling to a REIT.
Okay.
And I don't see that changing anytime soon.
So what do the REITs see in the market that the private want to get away from?
The private are selling for a reason usually unrelated to the real estate.
Okay.
And the REITs are getting in because most specifically on the healthcare side, how strong our healthcare market is. Yeah. In terms of tenant demand, and then also just services needed in the state.
Yeah.
Is the conversation, I'm curious about healthcare, because I think about this just from a personal level, is like you pay attention to anything. Everyone, especially as in American society, we're just getting unhealthier by the day. Are the investors subscribing to that concept? Is that like a driver? Because we're seeing, no doubt in my mind, without even knowing the numbers, the volume of patients, of chronic disease influx into these facilities, right? That's got to be lifting these healthcare providers and clinics up. if you're an investor, I mean, how can you not see the writing? I'm sitting here going, why the hell am I not buying healthcare?
I think
real
everyone's
estate,
getting
right?
healthier. Ozempic's like way on the rise, dude. What are you talking about?
Yeah. The trends we follow are like the insurance market, commercial insurance market, and how they're billing the healthcare tenants, because that's going to affect how much rent they can pay. And so healthcare is an interesting business because there's so many things outside of the real estate that actually affect our deals. So it's really interesting to see what kind of influence things that you can't control have on what we're doing. But that's also why there's like the cap rate compression is just relentless in healthcare. I mean, we're like high fives right now. And
Where were you 5 years ago before the pandemic?
low fives, 5.25.
Wow. So you guys are about
So
close to the same.
yeah.
Whereas we were like in the 4s and now we're in the 5s.
Yeah.
Yeah.
The money being pumped into healthcare. So in this meeting we were at, we had a client dinner, some healthcare clients a couple of days ago, and they just can't wait to get back into the market. And the tricky part about healthcare in the Northwest is that everything got so expensive because everyone wanted to be here.
Yeah.
You know, just like the apartment market.
Yep.
And so if you look at transactions on a national level, they're all happening in like the Sun Belt.
Due to affordability.
Yes. Yeah. You're still in the 7 caps ranges.
Wow.
And on the West Coast, it's very, very hard barrier to entry.
So speaking of that, though, transitioning a little bit for some optimism, what are you excited about? So you say people just can't wait to get in. What's going to make them get in 2025? What do you think's going to happen?
It's in its simplest form. It's like the spread between what the seller and the buyer and
so
the
you're
expectations.
still fighting that.
That's really what it comes down to in terms of transaction. What I'm excited for, I could see new medical office development happening sooner than later.
Because that hasn't been happening today.
Hasn't happened for 10 years.
Wow.
And when it did happen, it was, so the last spec project we worked on, it was 100,000 square feet of medical office. And it started 10 years ago. And the last building completed was 4 or 5 years ago, 2019. Wow. 100% leased, highest rents in the market. But what has killed the development market is simply construction costs. And there's 2 things happening. Me hoping that construction costs come down a little, but rental rates are increasing. So if we were in the low 30s triple net for the last few years, we're now pushing like high 30s, and we're into the 40s in the Bellevue and Seattle.
So you're seeing organic growth, which we haven't seen in apartments for a little while. A little while being 5 years.
Okay, right? We're seeing huge
other
rent
than
growth.
Bellevue. So it's like we need that because I don't think costs are going to come down significantly. I think that it's more likely the income goes up.
I can tell you what I'm excited about.
What's that?
100% bonus depreciation coming back.
Is it guaranteed or?
I mean, there's no guarantee, but I think everyone
dreamt it up.
I think we used to have it. They've been phasing it out, but if that comes back, that'll be really exciting. For the retail owners at least, especially automotive based or gas stations. That stuff's huge. Yeah, it's great.
Big deal.
Yeah, huge tax hit. It's great.
I'm excited for the overall sentiment. I think that people, because Trump's in office, I think that is in people's brains. And they're more excited to transact than they have been over the last couple of years. And I'm excited that the election's over. You know, it's been a really big focal point for a long time. And it's held a lot of people back from really even doing anything. So I'm excited that we can now see what we're, going to be dealing with for the next 4 years. And a lot of people are more excited to do business, period.
Yeah, that's fair.
I think to your point, we've been living in this transitionary period since, call it, I think it started in May of 22, right? With that first interest rate hike and everyone, that was felt like the party was over, right? And then we've spent the past, 2+ years trying to figure it out. Well, it's been about the same now for a good period of time. We already feel like we know what 25 is going to look like from a pure just, understanding federal policy, where rates are at, what financing looks like, what values are at, right? We've seen cap rates start to stabilize. Now we know how to actually go out there and execute, right? In 25. It's not a guessing game anymore. I think most buyers and sellers feel like they can go into 25 knowing, okay, this is the playbook. So if we're going to play, this is how we got to play.
Yeah. Most excited for me in our office, we're calling it the September to remember. And now we want to forget about it. But back to the segment you were talking about, the $10 to $30 million apartment transactions is where I spend all my time. And we had maybe 3 or 4 close the entire year. And then we had, I think, 9 or 10 go under contract in September. And we're just like, oh my gosh, we're back. So the exciting part was that the money and the buyers and everyone was ready when the interest rates did improve a little bit and the margins started to make sense. We didn't need to wait for any more adjustment in pricing. It happened. The challenge is interest rates shot back up and almost all those deals died. So I'm excited about those same buyers, those same sellers. The market will be right sooner than later. I don't know when, to make those sales happen. And there's a lot of people that have held out for long enough on the sell side. They're like, I just don't want to lose here, and I hope they make their money. And then buyers are like, I'm ready to go. I want to own more in this state, in the city.
I mean, I don't really see Seattle apartments getting cheaper than they are today.
No.
You know, I mean, there's a lot. I'm seeing deals even at $190 a unit sometimes.
Mm-hmm.
You know, and that to me is the bottom. You know, yeah. I mean, there's transactions in Tacoma that are much higher than that, and you know, it's like, how could Tacoma possibly be worth more than Seattle?
Yeah.
You know, so I think we're there, and I think those who realize it are going to be very happy that they realize that. And they're going to see almost immediate impact, I believe. You know, I mean, there's no reason they should be trading at that level.
Yeah. I was thinking, if you had a client, if you could talk to a client and not get fired, what advice or what would you tell them?
Oh, man.
And what was making me think of it, they will. But I'd say what makes me think of it, our team, and I know you're here for a reason, you guys are the biggest hitters in our industry. Our team does such a robust job marketing a property that I know we've turned over every rock, we've made a market. Our rule is minimum of 3 offers, and we do that every time we get a listing. Mm-hmm. That is the market. And so some of these people, I think, what I struggle with is this, oh, you just want me to sell. I'm like, you called me to sell. We did the job. If you're a seller, that is the market. Like you said, just take it today. Don't predict some future event's going to make things a lot better or a lot worse. So I think that's the big one, is just trust we did our job. We don't waste our time. We don't waste your time. We spend a lot of effort, money, markets, you name it, to make sure we're the broadest exposure we possibly get. That is the truth, even if you don't like it. And that's what I'd love to be able to just say to people. But instead I dance around. I'm like, oh, let's give it 60 more days.
I kind of say this actually quite a bit, but
Coach,
it doesn't always get listened to, which is the hard part. and part of it is because a lot of times it's not my money, and so I get it. Yeah. I can only push the issue so hard. But especially from an institutional standpoint, you think about a typical institutional buyer, right? They're playing with other people's money, right? It could be life insurance or pension funds, so they have to be stewards of that money. It's very delicate, right? But the amount of deals that I've seen groups lose over marginal amounts of money, and with me being the broker, boots on the ground, that they are trusting as the expert, whether you believe I'm an expert or not, that's my position in the deal, right? Yeah. And we're fighting over marginal amounts of money, and I'm saying, do you like the deal? Do you like everything? Yes. Then overpay a little. If you think you're overpaying by this marginal amount, then just do it, right? But they're so afraid of being wrong, and I feel bad. I'm calling out the institutional group, right? But we've seen it happen on every level of investor. Yeah. But don't be afraid to overpay a little bit or do what you need to do to win the deal today. Because if you believe in the deal, you believe in the real estate, you believe in whatever it is, right? Generally speaking, you're going to be okay in the future. Yeah. Easy to say because a lot of that happened in 21 and 22, and then maybe today doesn't look so good. But do those deals in 21 and 22 end up shaping out okay and 26, 27, 28, probably, right? Yeah. But just being real and telling people to don't be afraid, do it.
Yeah, that's a good point.
It's a little bit of a bet, but
I'd say, go with your gut. And underwriting a deal has just changed so much in the last 5 years, and people are still wanting yesterday's pricing. And so just being bluntly honest with them and go with your gut, and paralysis by analysis is just still hanging around. And you can't, every deal that we come across now is completely different than the one we just worked on the hour before. Mm-hmm. And the underwriting box is broken in every single conversation we've had. Nothing fits in the box anymore. So you can sit on your hands and not do anything. You'll be in the same position in 12 months and 24 months.
Yeah.
36 months.
Yeah.
So you got to go with your gut, and if you feel like there's a compelling story behind the transaction, you need to make a move on it. And I think that, for example, personally, my brother and I are buying an apartment building right now in Tacoma for $175 a door. I'm ecstatic about it. I think it's an awesome deal.
Nice.
But no one else. I mean, it was on the market for 12 months. Like, no one else wanted to touch it, and I'm sitting there like, what am I missing? I feel like this is a great opportunity.
Yeah.
But to Jake's point earlier, just people were wanting to, if there was a decision to be made, people didn't want to make it.
Yeah, it's what I've seen is they want 10 people around them to be pushing them, and they're confident enough to do it, and then they overpay.
Yeah.
But if you're just standing there alone, and me included, it's very hard to make that decision.
Yeah, and it's two of us, my brother and I, were just sitting here like, okay, we are in real estate. Like, what are we missing?
Yeah.
Like, this is a great deal. We should do this deal. And
That's it. You're done.
Yeah, we're done.
Yeah.
You're right. Yeah, you're done.
I mean, I pretty much say whatever I want. I'm not gonna lie.
Yeah, that's true. If I had 260 deals closing a year, I would too.
I mean, I pretty much
26
just
is a great
call it.
year
I
for
hit
me.
them in between the eyes. Sometimes they don't like it. Sometimes, one thing I really pissed someone off. I said, "Hey, look, man, you want to play in the big boy game? Then you got to get your big boy pants on."
I think you said that to me once.
I've said that a few times, and that guy wasn't very happy with me. I'll tell you that much. But you got to check your ego at the door, right? Like it doesn't really matter. What they think. As long as you're shooting them straight, then you're doing them right.
I like that.
I would just say for the retail owners, it's been really good for a long time, and maybe it lasts longer, but historically speaking, everything ebbs and flows. So if you own a multi-tenant shopping center, you should sell now. Seriously. We're at like peak pricing levels with 6+% interest rates. It's a supply and demand factor right now, which who knows if it lasts. And, retail fundamentals are very volatile, depending on consumer activity and spending power. So they can change very quickly.
And back to where we started this conversation on timing, I've seen more people lose money by trying to time things than make money.
Yeah.
And I can point to many more clients that held back for the last few drops and lost a lot because of things like the pandemic that none of us foresaw.
Yep.
I would rewind to the last time we were on this podcast, and you said that multi-tenant retail was going to be the darling.
Thank
and
you
here
for
we are.
mentioning that, because
That's
I was
right.
going to plug.
That's right.
Hit it. Boom. Boom.
One of your
Insert
crystal
that.
balls was right. That's
One of my-
Exactly right.
Insert
right.
that clip.
He's got two crystal balls.
Yeah.
Can we insert that clip?
Yeah, we can. So then flipping it, what's your advice to a buyer right now? I'll go first. I've been saying it for several months. It's just like, now is such a good time to buy. I've been doing this for 10 years now. I think there are people out there that have been doing it a lot longer than I have, owners that have held for 40 years. But because of the volume of transactions we do, I looked last week, we've closed 168 sales since the pandemic. It's a lot of information. And I'm going to say without a shadow of a doubt, I don't think things are going to get cheaper. So if you've been considering buying, I think you've got some time, but just back to that September, rates improved by 50 to 75 basis points. Everyone was confident again. You just waited for all your competition to show up. So as you're standing there alone, like, what am I missing? Go with your gut. I think as a buyer, like, now is a great time to buy, especially urban properties in Seattle.
You keep harping on timing the deal, right? And making sure, and a lot of guys missing out on timing. But the reality is, if you like the deal, who cares at what point in time you're doing it, right?
Yeah.
If the deal works, the numbers work, and you like it, do it. And I was just preaching, don't be afraid to overpay a little bit.
Yeah.
I think right now, that probably resonates more than ever because we do all collectively agree as the boots on the ground and the experts on what's going on that pricing is probably as attractive as we've seen in recent years. So, I mean, I had a great example a couple weeks ago of one of these where I kind of was looking at the numbers and it was overpriced by like 10%, but the future potential of it looks so good. And after beating it every way to Sunday, there was no way to get that 10% off. So we paid the extra 10%.
Yeah.
And it was, no doubt in my mind, it was the right move.
And that's where we're at, I guess, to go a little more granular. Not a lot of the deals I sell pencil, but they're 30 to 40% off of where they may have sold at the peak. So you are buying a great basis, you're buying a great location, you're buying in a great city. and a great economy. And so if you need it to like pencil out the gate and all the things, it'll never get there.
It doesn't fit in the box. Like
Yeah.
we were talking.
So if you want to go suburban and be more speculative and get your cash flow, great. You can, but to have some of these, what I think are going to be home runs, it's standing there on the 50-yard line saying like, why won't this work? I can't think of why. Let's do the deal. Let's maybe put a reserve account aside for the next couple of years to make sure we're covered. But I think there's some massive appreciation ahead.
Yeah, buy office.
Buy
Buy
office.
office.
Buy office.
You're-
Have you bought any office?
No. We sold, personally, we sold our office product in 2021, our last office building, and we put it in multifamily in Eastern Washington with your team. And we are now back in investing in Pierce County and the Puget Sound.
Nice.
And
So you got out at the top and now you're...
Yeah, I'm jumping back in. But,
Nice.
so yeah, I'm pretty optimistic. But I'd say buy office. So if you traditionally are an office developer or an office investor and you know what you're doing, you've been doing it for a while, there is no reason why you shouldn't be buying a building.
Yeah.
You're sub $100 a foot on these value add projects. Buildings are trading for 75% decreases in what they had previously traded for. And if you know what you're doing and you have the right team around you, you're going to be able to attack the vacancy and lease it, because there are tenants out there. And it's not like there's a lack of tenant depth. It's just a different tenant. It used to be your tech tenant leasing an entire building or floors at a time. Now it's your traditional services and your law firms, your financial institutions leasing 5,000 to 10,000 feet. Mm-hmm. So there's still activity. You just need to approach it correctly. And for the last 18 months, it's been super stagnant, like almost 100% drop in transaction volume. Mm-hmm. But over the last 6 months, there's been value add deals that have traded up and down Pierce County, and they're all in the $65 to $100 a foot range. Mm-hmm. And every buyer is a reputable buyer that's been in the game for a long time and they know what they're doing. Mm. And they're buying from a seller who had bought a building as part of a fund or because it was a coupon clipper. Yeah. And so I really like the changing of the guard and I like where we're headed. It is a long road, right? I think it's a 5-year recovery for the office market because we do have a ton of vacancy that we need to absorb. Mm-hmm. But I'm really optimistic with these players that are back in the market.
I'll just add on that, coming from a retail guy, so take it with a grain of salt, but I had to hear for 5 years straight when Amazon, believe it or not, used to be like a new thing where you could press a button and stuff would show up at your house. So when that started happening, I had to hear for 5 years straight, similar to every retail guy, retail's dead. Like, what, dude, you got to go find another job. I'm like, okay. And I just stuck through it. And now everyone wants retail. Yeah. So I would just say what happened with office from my perspective is you got hit immediately. If retail would have got hit immediately with the internet, it was gradual, that kept growing, we would have been in the same position. So it'll be a 5 to 10 year recovery period, maybe quicker, with back to office, if we can figure out some of the crime issues and vacancy in these cities. I mean, we're all of the age with, kids or young families, like working from home is not great, right? So, I actually think I'm actually a bigger believer than I've probably ever been, than on office. So
that's been my big argument to some of my clients that are smart, wise, been around for a long time in their 60s. They're like, nope, work from home is like a predominant thing that's going to last forever. And I'm like, says the guy that doesn't have kids anymore. Exactly. I have a new kid. And the problem is, it's going to sound maybe a little soft, but I like him too much. So I'm at home. Yeah. I want to hang out with him. Yeah. It's like a distraction. It's like a video game back when I was 20. Yeah. And so like going to the office is actually how I can focus.
Yeah. Never leaving your house gets old, right?
So, well, plus you're not as productive because collaboration really does matter.
It does,
and there's an energy level associated with it. And I think that we're realizing that. But I think hybrid is the future, personally, where you can do your tasks, you can do what you need to do on a daily basis, you can go on your appointments, and you're at the office too a lot of the time. And I think more than ever, personal and work are blended together, to where you're working while your baby is sleeping or whatever it may be. And so I think that there's a big push coming back for office too. I agree with you.
So you see all sectors, including people that aren't represented here, like hospitality. Mm-hmm. What do you think biggest opportunity next year? Your office?
I think office is the biggest opportunity, but I think Will's definitely accurate in that it's not for everyone.
Yeah.
Not everyone should jump into office.
Yeah, like
That's
even
not a
myself,
good
I'm
idea.
like, oh, should we? Yeah, let's do it.
Yeah, I mean, there's a way to do it, but it's all about quality. You know, like the places that aren't quality, they're going to continue to struggle. The big boxes, they're going to be downsized from.
Gotcha.
And they're going to struggle to basically find new backfill.
Yeah. But you're like, I would say more so than anyone here, debt being, let's call it 2/3 of every transaction. Everyone could do it themselves several years ago. Now, I recommend to everyone, you need a debt broker to get these closed. So you're dealing with different types of properties, different types of buyers. Like psychologically, what are you telling buyers? Like how do they get out of their own way next year and get more deals done?
Well, I think that we need to get away from this mindset that rates are just going to drop.
Yeah.
First and foremost, you know, there's only really two ways in which they drop that quickly, which is a huge recession, which means we're all in pain, right? And you may not be able to refinance because you're underwater anyways at that stage.
Yeah.
Or B is if there's a huge world war, and then we got a whole other set of issues.
Yeah.
Other than that, I think rates are, to Matt's point earlier, they're somewhat stabilized at this stage.
You know what you're getting.
And as they continue to drop the Fed fund rate, I really don't think that they're going to change that much that quickly. You know, they pop up and down pretty regularly, but overall they're pretty much the same, right, over the last year or so. So I think understanding that, and then also understanding that there's different financing sources based upon what your long-term project goals are, and pairing those goals with the right funding source is really paramount to the overall cost effectiveness of a transaction. And a lot of people just get fixated on a rate. Well, if you're going to exit the deal in a year and you got a 5% prepay, then really what's your effective rate?
Yeah.
You know, and people need to take consideration to all the cards, and also, you know, what's the opportunity cost loss if you have to put more down and you get a lower leverage deal? Yeah. You know, there's a lot of different factors in it that people tend to neglect sometimes. And that's part of our process, you know, is helping with fact finding to open their eyes to see the bigger picture.
I'll close on something you said. It made me think of a conversation I had with my wife many times, but this idea that rates are just going to come down reminds me of, I graduated college in 2011. GFC, Great Financial Crisis, arguably started in 07, 08. So when we were coming out of college, none of us had money. A couple kids did and bought these ridiculously cheap homes. And so when the rest of us were going to buy homes, it's like, oh, we'll just wait for another, GFC. It's been next year, effectively 18 years later, there hasn't been one. And we've been through a pandemic and a handful of other things. So I think it's just making me think that, like, you need a home, go buy a home. Don't wait. It's just going to keep going.
I told you about the study the other day that I saw, though, at the same time, that was based upon some Fannie reports, and it was
Scare
really,
him, Jake. Scare him.
It was eye-popping. You know? Did you see it?
No.
Okay,
no.
So basically what it says is for housing to go back to the same level of affordability as 2016 to 2019, one of three things needed to happen, or a combination of three things needed to happen. Either prices needed to go down 38%, rates needed to drop to 2.5%, or income needed to raise 60%.
Wow.
So all of which are never going to happen, at least in the short term.
Which is crazy.
But what one's the most likely to happen? Pricing come down?
I think it's probably wage increase, personally.
Really?
That's what I think, personally. That was my vote on a poll.
Could you?
Put it that way.
That's great. Well, I hope everyone's making 60% more next year, including all of you.
Yeah.
Awesome. Thank you so much for joining us. Follow us to learn more about commercial real estate in the Pacific Northwest.